Should I set up my business as a limited company or sole trader? If you're thinking about setting up a business but aren't sure whether to operate as a sole trader or form a limited company, this is the video for you. I'll cover everything you need to know, the differences, advantages, and disadvantages of each, so you know which one is best for you. There are 6 parts of the video. If you have a question, ask in the comments and we'll respond to you as quickly and fully as we can. So let's jump into the first consideration, risk. On the most basic level, a sole trader is just you. In the eyes of the law and HMRC, you and the business are the same thing. That means if something goes wrong, angry customers, suppliers, or third parties could hold you personally liable for any debts or legal action taken against you. In contrast, a limited company is its own legal entity that's entirely separate to you as the business owner for tax and legal purposes. Customers and suppliers form a contract with your limited company, not you, which means that if things do go wrong, you only risk what's in the company, not your personal assets. In other words, your liability is limited, hence the name limited company. This is a big deal, and by itself could be enough reason for you to choose operating as a limited company. However, one important point to note is that a limited company does not protect you if you've entered into contracts that use your personal assets as a guarantee. This is very common when taking out bank loans or financial products, so watch out for this. Tax. The second major benefit is potential tax savings. As a general rule, if you make over £30,000 of profit, you're likely to be financially better off operating through a limited company. The more money you make, the better off you're likely to be by operating as a limited company. The main reason behind this is because sole traders pay income tax and national insurance on any profits made. However, limited companies only pay corporation tax and crucially do not pay any national insurance on their profits. In addition, operating as a limited company allows you to withdraw money from the company through dividends, which are far more tax efficient than personal income. For example, for the 2023-2024 tax year, you would only pay an 8.75% tax rate on dividend income versus 20% personal income tax rate on any earning between £12,570 and £5,270. That is a huge difference, and the more money you make, the bigger the difference can become. Sole traders can't pay themselves in dividends, and is a core reason why a limited company is very likely to be the more tax efficient if you think your business will make profits of over 30k. Cash flow. The third point is around cash flow. This point is often overlooked, but is critical to consider. Sole traders get a really rough deal here with a system called payment on account. Payment on account requires you to pay in advance towards your next income tax bill. The amount of tax you pay in advance is worked out on the assumption that your income will be similar from year to year, which obviously isn't always the case. You'll normally pay 2 payments on account over the year. The first one by midnight on 31st of January, and the second one by midnight on 31st of July. The idea of payments on account is to spread the financial load across the year so that self-employed people don't have to pay their entire tax bill at once. However, in reality, it means you're always paying tax in advance of earning the corresponding income, leaving you out of pocket from a cash flow perspective. Not ideal. In contrast, limited companies only pay tax once a year. Furthermore, this tax is due 9 months after the financial year ends, providing a huge cash flow advantage over operating as a sole trader, where you pay tax 6 months in advance. This makes life so much simpler and keeps cash in your business, rather than HMRC's accounts. This is certainly something to consider and becomes increasingly important if you have a profitable year with a big tax bill due. Cost and complexity. The fourth consideration is that the cost of running a limited company is more than that of being a sole trader. Setting up as a sole trader is free and fast. You can register as a sole trader and file your yearly accounts yourself on HMRC's own website. It's pretty straightforward to do all this yourself, or you can use an online self-assessment service for about £100 a year. Limited companies are a bit different. Although you can set up a limited company yourself via HMRC's website for just £12, it's the ongoing accounting requirement, which is far more complex. HMRC requires limited companies to submit detailed yearly accounts that are compliant with the ever-changing tax rules and rates in their own unique format. Because of this complexity and significant fines for late or incorrect submission, most people use accountants to look after their accounts for them. Until recently, the average accountant cost around £1,000 to £1,500 a year. However, new specialist tech services such as Mighty will now take care of everything for just £500 a year. That covers everything you need in one fixed price: bookkeeping software, unlimited accounting support, yearly accounts, and company's house filings. With this level of pricing, it's therefore highly likely you will save far more money in tax than the extra cost of your yearly accounts. Flexibility. The fifth point is around flexibility. As a sole trader, you can cease being self-employed instantly at no cost. You can just tell HMRC you're no longer trading and you're done. Quick, easy, and free. However, with limited companies, it can be more complicated to shut down. If you haven't operated through your company for a while and your company is dormant, this process is pretty easy. You can simply dissolve your company and get it struck off at Companies House. However, if you've been actively operating your company and now want to shut it down, the process is more complicated. There's forms to fill out, accounts to close, and a cost involved. The more complex your business, the higher the cost to shut down, but it shouldn't cost a fortune. A few £100s should be enough. Therefore, if you're not yet committed to starting a business, it might be better to start as a sole trader and open a limited company once you're ready. Credibility. The last point is around credibility. For all the reasons we've just been through, it's very common for people to perceive limited companies as having a higher degree of professionalism, commitment, and success than sole traders. In fact, many customers and suppliers insist on only doing business with a limited company. This is far more common than you may think, especially if you're selling services to other businesses. Therefore, depending on your customers and suppliers, being a limited company for this reason alone can be a critical consideration. Rounding everything up, if you believe you'll make over £30,000 per year, it's probably preferable to operate as a limited company. Yes, it's a bit more expensive, but it's likely to be a very small price to pay in comparison to the tax savings you'll make and protection of your personal asset if something goes wrong. If you're just starting out and aren't sure if you'll reach £30,000 in profits in your first year, it's worth discussing your personal circumstances and business plans with an accountant. If you'd like to discuss this very point with us, we offer a free consultation to advise you on what's best for you. We can even set up your limited company for free if that's the best route for you. I'll leave a link to book a consultation below. Just book a time and we'll be happy to advise. Be sure to like and subscribe if you found the video helpful so more tax tips make their way into your feed. And if you have any questions, drop them in the comments and we'll surely answer them for you. See you in the next video.